Hi, everyone. Thank you for joining us this afternoon. The topic of today's panel is one that's been continually front of mind for the industry and for those of us up here, the focus of our work for several years, institutional integration, bridging traditional finance into crypto. I'm Diana Biggs, one of the partners at early-stage crypto venture firm 1KX. And I'm delighted to be joined on stage today by an impressive panel, all of whom began their careers in traditional finance before themselves making the move over to crypto. So to start, I'll ask the panel to please introduce themselves, their roles, and organizations. Josh?
Hey, everyone. Pleasure to be here. My name is Joshua Lem. I've co-founded a firm called Arbalos Markets. It's probably one you have not heard about, but we just got started. Most of us come from a derivatives trading background, mostly options trading in traditional markets. And we spent the last, I guess, like 8 to 10 years of our lives trading crypto as it's evolved from a very retail-oriented asset class to a much more institutional-facing one. So we come from backgrounds like Circle and Galaxy and Genesis and Ledger Prime. We kind of helped like spin up the bilateral trading market for crypto derivatives. So yeah.
Eva.
Hi, everyone. My name is Eva Lawrence. I am head of EMEA for Figment. We are the leading institutional staking provider. We help everyone from asset managers, hedge funds, to exchanges and custodians stake their proof-of-stake tokens or assist their clients in doing so, covering everything from Ethereum, Solana, Polkadot, Avalanche. I started my career, as Diana said, in traditional finance. I was at Morgan Stanley for 8.5 years. I ran their EMEA flow trading desk for securities lending. And then about 5.5 years ago now, I came to the light side, joined crypto.
Hi, my name is Joonkee. I joined the Cumberland DLW in the middle of 2018. Before that, I have about 30 years of experience at the investment banking area. For example, I ran capital markets division of Lehman Brothers in Asia. I worked for UBS Investment Bank. I worked for Nomura Securities International. Worked for Solomon Brothers, various Wall Street companies. I'm disclosing my age when I say 30 years of experience, but I'm happy to be here. Thank you.
Great. So you've all been working in this industry already across several years, been through a number of market cycles. I think it's without a doubt that the events of last year slowed the pace of institutional adoption, but we're beginning to see more positive signs of late. We have BlackRock filing for an ETF. We have Deutsche Bank, BNY, State Street, others moving into custody. From each of your vantage points, where are we now in terms of institutional adoption and integration, and how are you seeing that evolve?
Yeah, I think the one thing we can take away from the last cycle is that crypto got very big very fast, and in a lot of ways, like we tried to import the leverage and the capital efficiency from TradFi without implementing a lot of the controls, the safety measures, and the backstops, right? So. And in some ways, crypto is not amenable to those types of things. You can't implement like a central bank in crypto. But yeah, I think what we've seen, I think, through living through a couple of these cycles is that like we've removed in a lot of ways like the existential left tail of crypto. Like crypto's always going to exist. There's always going to be CME futures listed on crypto, I hope. But that means that it's like a viable investable asset class for most portfolio managers, macro portfolio managers. So there's always going to be some, I think, reason for it to exist. People are going to allocate into it. I think we've all heard the macro speakers in this conference talk about how it's become this inflation hedge, this sort of fixed supply asset that has scarcity and some monetary value to people's portfolios. So I think that's the main takeaway from the last cycle is that we are all in it to kind of see this asset become a global investable asset class for most macro managers out there. Yeah.
Yeah, and I think we kind of just want it to become just another asset class, right? So something that doesn't necessarily grab headlines all the time because it's just considered, another an asset class next to commodities or equities. But I think that the institutions are still very much here. They've not left the building, but they're maybe a little bit less vocal about what they're doing. They're more private now. They're either building, developing, growing teams in private. That being said, we have had some announcements in this space, as you mentioned, Dinah, around custody. Also, structured products is another area that we've seen growth of late. New firms offering ETPs and ETFs. We've seen that particularly in Europe. There's been a growth in that side of the space. So I think it's continuing to build, continuing to grow, and develop the maturity in the space with the right risk parameters.
Yeah, since I joined Cumberland in 2018 from the traditional finance, I always expected kind of full adaptation of cryptocurrency and crypto assets by the institutional investors because they have to, right? The whole asset management is built on the theory called modern portfolio theory. And according to that, if you add another asset which is not correlated with your current portfolio, the return is additive, but the risk is not additive. It's always less than the additional asset. So the goal of the asset manager is always try to find alternative asset with low correlation to the current portfolio, and the cryptocurrency provides that. Right, so global asset management side is about $100 trillion. It always goes up and down. But even if these institutional investors allocate 1% into the crypto space, you're talking about $1 trillion of new money coming into crypto space compared to I think that's the size of the whole crypto assets today. And for example, twice as big as a Bitcoin market cap of 500 billion. So that's the kind of adaptation I'm looking for. If you look at all the surveys done, I think Fidelity, who will be also speaking, I think soon in this event. Fidelity always annually they do a survey of institutional investors. The latest one came out, published in October 2022. And you can follow every year their survey, and you can see the nice continuous growth of the institutional adoption, because they survey about 1,000 institutional investors globally. EY had a survey done as well. Some surprising results, something like they surveyed 250 institutions, about those with more than $500 billion of AUM, about 45% of them already invest into digital assets. So it's a surprising number. From Cumberland experience, we see Goldman and Nomura trade with us, right? So it's well published that they trade with Cumberland. So you can see all these institutions coming in, as I expected that because they have to, and their clients demand that as well.
I think we've been hearing for quite some time that they are coming in, and we're still waiting. We're 13, 14 years in. Why haven't we seen more? What are you guys seeing as the gaps that still exist? Is it a lack of systemization, sophistication, or what's needed to actually get more players making meaningful engagement with the space?
So I think the collapse of the last cycle kind of exposed a couple things, right? It exposed that in traditional markets, there's a lot of structure to that market that doesn't exist in crypto, which includes like regulatory oversight and sort of like forced transparency in the form of like public disclosures and filings. And those types of things don't exist in crypto, but can and should exist in crypto. In fact, they can leverage a lot of the primitives that already exist in blockchains that are inherent to blockchains. So I think that's the one thing that I hope is the takeaway from this cycle. I think a lot of firms are building it. I think we're building it ourselves internally just to service our counterparties, people who are lending to us, providing balance sheet to us, trading derivatives with us, where it's very easy to give people a full accounting of where our assets are and our liabilities are. We can sort of remove one trust assumption by letting people see like what we're doing with our balance sheet in a not completely sort of like zero knowledge way, but in a way that preserves our privacy and our clients' privacy. But if we do that, and if other firms do adopt that same level of transparency, then you can have an entire market that operates very different than TradFi, where you can get real-time sort of risk readouts of your counterparty's health. And I think that's one thing I think we should all strive for in crypto.
Yeah, I think transparency is key. I definitely would agree with that.
Mm-hmm.
Also, I would say liquidity is another area where we need to see development, both breadth and depth of liquidity in the market. I think this will come with the maturity of the market in general, but I think that having kind of increased liquidity and more optionality around trading would help. And then I think data is another area that institutions could see the benefit of improved growth in the industry. So if we had more reliable and robust data in the industry, that would help firms to build products, to market investors. It would help, asset managers to stress test, the variability of the environment of those assets. So I think that there's definitely something to be said for data, and as a firm, it's something that we've looked at internally. We've recently partnered with Market Vector to launch a staking rewards rate index. So think of it similar to a risk-free rate in the traditional markets, to figure out or to provide the data for someone to figure out what is the annualized reward rate for staking ETH. And with this data, what firms can do is then build an ETP, build a crypto TRS product. So I think having that data not only provides kind of comfort and clarity for the industry, but it will also help institutions to build and grow.
I think there are two types of adoption by institutional investors. One is value proposition, so getting exposure to digital asset value. The other one is actually investing into spot crypto. So there are two different things. I think it's a stage, right? Currently, if you look at the institutional investors who have to have for example, both fiduciary duty to their clients as well as regulatory duties for their reporting. They have an infrastructure which they have to, for example, manage the risk management. They have to do legal and compliance work. They have to produce reporting to the regulators. They have a lot of infrastructure necessary, but they cannot connect that into the cryptocurrency. For example, wallet or cryptocurrency spot. So instead, they are looking for familiar security type. That's why BlackRock, Fidelity, Invesco, everybody in traditional finance, they want spot ETF because they can get exposure to cryptocurrency value without unfamiliarity of actual technology. So they can use the familiar security of ETF. And it fits right into their reporting, their internal risk management, whatever they need to do, and they are doing currently, they can do it using ETF. So that's the entry point adoption. Second full adoption is actually like a BlackRock and Goldman and all these guys actually going into actual spot cryptocurrency. That requires infrastructure, technological infrastructure of a wallet infrastructure, key infrastructure. Before our panel discussion, there was a wallet discussion going on. You know how complicated and difficult it can be, and very difficult actually for financial companies to master at these things. So that part, the full adoption, will take some time for them to learn about the technology and adapt into technology.
And Joonkee, I would also love to hear from you, being based here in Korea, how has the local environment been in order for institutions to engage, and how do you see that progressing?
Yes, I'm based in Korea for Cumberland. Cumberland, as I said, is one of the largest OTC trading company. But if you look at Korean market, for example, Bitcoin to Korean won, fiat currency, that product is actually quite different from Bitcoin to US dollar, right? People will say, oh, it's a Bitcoin. So isn't it saying Bitcoin? Can you trade Bitcoin? But Bitcoin Korean won based is quite different from Bitcoin US dollar basis, especially because of the heavy cross-border capital control Korea has. So for us to do our proper liquidity provider work and help the ecosystem get access to cryptocurrency, we need to be able to hedge our position in Korea. That requires us to, for example, be able to trade on the platform, like Upbit cryptocurrency platform, which is like a second largest fiat-based cryptocurrency exchange globally, for example. We cannot get onboarded there and trade because current regulation does not allow any legal entities or institutions to trade in Korea. So clearly, compared to what's happening globally, all these BlackRock and Fidelity and everybody is coming in and developing their infrastructure for digital assets. Korea is completely missing out because Korean institutions cannot join. So I like to make sure that hopefully we can open up the market in Korea soon so that institutions can trade in Korea.
Thank you. Just to further expand also, Josh, on your last point with regards to the need for this simultaneously transparency and privacy. Mm-hmm. How do you see that working, and where are the needs and the opportunities there?
Yeah, I think you're kind of seeing it play out in multiple ways within crypto market structure. There's a migration towards trust and sort of like venues that are either highly regulated or highly transparent, right? And they're kind of on opposite sides of the spectrum. One side is something that looks like a CME future, like an upcoming Bitcoin ETF, where there's a lot of reporting around it. So it's sort of like enforced transparency by mandate from the government. And on the other side, it's sort of like the ethos of crypto, where it's decentralized and on-chain. So things like DYDX, these sort of like on-chain perp dexes, where you kind of know where the collateral sits. You know that everyone's abiding by the same margining rules and liquidation rules, which obviously that was the big cause of some of the larger bankruptcies in the 2022 cycle, was that people weren't. Some market participants were not subject to the same liquidation rules as others. So I think if you think about that, it's a pretty obvious trend. You're seeing a lot more volume head to DeFi or to kind of CME from institutional market participants. So just extrapolating from there, like next cycle, we kind of think that more activity will happen in those two markets, and they're going to be pretty disparate. Like I think it's like different customer bases for both. Crypto native firms may not be able to get access to CME because you have to have CME is like a large regulated futures exchange in the U.S., Chicago Mercantile Exchange. So you might not be able to access that because you don't have the right regulatory setup to do so, or you can't find an intermediary to sort of like open an account for you. And then similarly, like if you're a Fidelity or something, you're probably not going to be able to participate in DeFi for many reasons. But there's going to be a need for firms that sit in between that are somewhat crypto native, like they can speak the language, they understand how to use the technology, but also have a lot of liquidity and pricing expertise, like to understand, how to sort of refactor liquidity between centralized and decentralized venues.
If we've found the right balance between transparency and privacy is when kind of those two areas start to converge, where we kind of see the less of that separation, where we kind of have struck the right balance between the two. Right. I'm not sure how long that will take.
Yeah, for sure. Yeah.
So on the topic, when we're looking at institutions actually engaging in the space, by and large, at least for the larger ones, this has been on permission networks. but it feels like there's a growing consensus that the future is on-chain. Do you agree, and how are you seeing this play out? Eva, let's start with you.
I do agree. I think kind of how we're seeing that play out seems to continue to change and continually evolve. One way that is coming up recently with institutions has been tokenization. And back when I had this word come up, maybe 6 months ago again, I thought, oh God, not this again. Haven't we done tokenization? Haven't we been through this part of the cycle? Why are people wanting to talk about tokenization again? But I think it wasn't from the point of view of, blockchain, not Bitcoin, let's tokenize the world. It was from the viewpoint from institutions' perspective to having kind of fractionalized ownership of real-world assets was useful, especially assets where they would traditionally be illiquid. So having this kind of entryway, this access point to these fractionalized ownership of these assets could be beneficial. So I would say, moving things on-chain to allow for partial ownership of traditionally illiquid assets is happening, is a benefit. And then also, the other area that we've seen is everything that banks have been looking at around settlement, right? That's another movement on chain. So you've got the assets themselves, and then you've got all of the areas that surround how settlements works, clearing works, execution of trades. So the process piece, you see more of a move to bring that on chain. So I think both are relevant and both are interesting. It's just which the banks are going to move quickest on. We know how slow they are, and you could lump large asset managers, large pension funds, hedge funds into that same bracket. But I think both from a product perspective and a process perspective, the future is on chain.
I absolutely agree. The future is on chain. It might look confusing at the moment. There was a crisis, Luna Terra crisis. There was a fallout of the FTX and things like that, which can confuse all of us. But being trained as an engineer, I do what I call boundary condition analysis, which is like you look at the boundary. Let's say in the futuristic boundary, I don't know, like 50 years from now or 100 years from now, I cannot imagine 100 years from now, all these asset classes are not tokenized, right? Because it's a pure commercial drive and the availability of technology to fulfill those commercial drive. It's more efficient, it's 24/7, 365 days, instantaneous settlement, T0 settlement. Who would not want that kind of technology, right? So hopefully it will not take 100 years, but my boundary, or 50 years, but my boundary condition analysis of happening, everything being tokenized, or the equity market and bond market, every asset class being tokenized 50 to 100 years from now, we can interpolate into today, and sometime in the future, when global regulatory things will be hashed out and all that, it'll happen. So absolutely agree.
Yeah, I mean, I think those are all good points. I think another reason to think about, this inevitable arc towards on-chain activity is that we all want the world to become more composable, and a lot of financial infrastructure in the US and elsewhere in Korea also is predicated on sort of like these walled gardens, right? Every company has an incentive to sort of like keep assets within their own four walls. And I think it's pretty clear just from the growth of DeFi in the last cycle and how much easier it was for retail market participants to do the types of speculation, financial activities, borrowing, lending on chain. That UX was very, very good. It was almost too good, right? It was so good that it caused a lot of leverage issues. But it's clear that people want that, and it's also better for these types of the power of these types of apps to be sort of like competed out to multiple providers, so that it's not sort of like centralized by one specific provider. And I think that's what you get when you put something on chain, is you just have a lot more competition. And I think people can sort of like migrate to the point of the stack where they can add the most value, right? So it's like, if you are really good at pricing things, you can be a liquidity provider on Uniswap. If you're really good at settlements, like you're building the smart contract for sort of like transferring those assets, and it doesn't require one company to be monolithically good at everything.
Yeah. And so when you're seeing institutions coming to you now, what is it that they're most interested in, or where are they seeing like potentially the most positive benefits? What's the current interest?
Me?
Maybe you.
I can go, yeah. So I mean, for us, we have definitely seen, and of course I'm slightly biased on this, we've seen more of an interest in proof of stake. As someone who has been involved primarily in Bitcoin for a long time, I've definitely seen over the last few years a lot of interest in growth of proof of stake networks, and in particular, the growth that we've seen on Ethereum, especially post-Shanghai. What institutions are looking at there is, okay, well, if I hold this asset already sitting on my balance sheet, how can I utilize it to earn a return without exposing myself to counterparty risk, without lending out my assets, without entering into some funky swap? What is the simplest way I can do that? And that is, of course, staking, non-custodial protocol staking, to be precise. And so I think that we're seeing firms who, they've got over the first hurdle. They hold assets, whether it's Bitcoin, whether it's Ethereum, or whether it's others. They've reached that hurdle, and they're like, okay, I hold the asset, so what's next? I think risk appetites will grow over time. But one area that we are seeing interest in is of course staking, and that's from everyone to hedge funds, small bank, asset manager, exchange offering to their clients, and everyone in between. So I would say slowly but surely those firms are looking at how these assets, these proof of stake assets, can be utilized to earn a return.
Do you have a take on what the size of that market could be, say 5 years?
God. I mean, I think for Ethereum, that's the one that everyone's watching, right? That's where we're really seeing the trajectory, go through the roof. I wouldn't like to make any predictions. I don't want to jinx anything, especially when it could impact our bread and butter. But I would say that we're seeing more and more firms looking to stake assets, ones that haven't even considered it in the past. So if we continue to see that upward trajectory, more clarity, more data in the market, and more firms being able to stake, staking ETPs as well added to the mix, I think the potential is huge.
Go ahead.
I was going to talk about the Korea, with a Korea perspective for the institutions coming in now. As I said, institutions cannot play in crypto. However, they know it's coming, so everybody's getting prepared. So when the government announced that they will allow STO, it was the STO guideline by Korean regulator, everybody jumped in. So it's as if like floodgate is open. Every major securities firms and banks are coming up and announcing that their plan for how to build a infrastructure for security token. So that's one allowed blockchain-based institutional play they can do. So those other areas, government. The reason for government allowing is it fits into what they want to develop, which is investment contract type security, like in the international market is like a fractionalization. So fractionalization of the fine art, real estate, all these things. It's not well defined or well managed in Korea. So regulators found out that it's a very good area for blockchain technology to crack at. So that's why STO market is opening up in Korea. And already more than 200, 250 proposals coming into government and regulators about what kind of security token people want to do. So that's something I think all the global audience should look for. This would be one of the interesting case of STO development from Korea.
Fantastic. Okay, we're out of time. Thank you, everyone, for joining us. Thank you to our panelists.
Thank you.
Thank you.